Okay, good morning, everybody. My name is Greg Firman. Now, what we're looking at today is the Forex Weekly Outlook. We're looking at expanding on our last webinar series where we're looking at using combining lagging indicators and leading indicators for directional trading in Forex and to help us be more profitable in our trading. Now, just a little bit about myself. My name is Greg Firman. I've worked in the futures and the Forex market for the last 12 years. I'm just going to share my screen here, get everything all prepared. Just one sec. Okay, we're set up and ready to go there. So I've worked in the futures and Forex market for about the last 12 years and founded E-Trade FX in 2006. I am Series 3 Commodity Futures and Series 34 Retail Forex licensed and registered with the Commodity Futures Trading Commission and the National Futures Association as a commodity trader advisor and an introducing broker. I've worked as an advisor to large hedge funds and individual traders worldwide, providing daily consulting for short, medium, and long-term trading, while also providing very specific risk management models with preservation of capital, the primary focus along with steady growth. I have further worked as a market analyst for TraderPlanet.com since 2008, a prominent free social media site that globally connects traders, where I provide daily commentary to a large number of followers in the Forex, futures, and stock markets. Now, looking at today's webinar, what we're going to be looking at here today in this Forex Weekly Outlook Special Edition is a complete review of the U.S. majors and how to trade them for this coming week. We're going to look at multiple time frame setups for short, medium, and longer term trading. We are also going to view the key cross pairs and how to trade them for market direction on specific pairs. And this week we're going to focus on Euro-US and Great Britain-US. With the cross pair we're going to focus on will be Euro Great Britain. We're then going to be looking at specific areas for stops to ensure that we're not taken out of these trades prematurely. And then, of course, a critical component of what I'm going to talk about here today is seasonal patterns and what to watch for, not only from month to month, but predominantly in the month of November. The month of November, we have the U.S. Thanksgiving, and there's always fireworks around this date. So with all that said, let's get started. We're going to begin with the U.S. dollar index. Now, I know that I've talked about this in previous webinars where a number of brokers are coming up with their own version of the U.S. dollar index. FXCM has one, different other brokers have one. The true U.S. dollar index, what I do with my own direct clients is I send them to Windsor Broker to use their free demo. I do not trade at Windsor Broker. I have no association with Windsor Broker. I do not promote them in any way. But they do offer us some very good free tools, which is the real U.S. dollar index futures contract, which is absolutely critical. In my view, if you're going to trade Forex, you need to know what this dollar index is doing. The real dollar index, it offers S&P 500 futures, gold futures, a number of other different futures contracts in currencies, all of which that help us in our day-to-day trading. By way of intermarket analysis, which is, again, very critical in our trading. So we're going to start here with the U.S. dollar index. And what I want to point out first and foremost is when we're looking at multiple time frame setups, and we should always go longer first and then come back into the shorter time frames. Now, again, I think I've used this analogy in the past when basically if you're trying to cross a highway and the speed limit is 60 miles an hour, you're looking for a place to cross the highway. The second you step onto that highway, you're probably going to get hit by a car because you can't judge where these cars are coming from. Now, if you take a step back half a mile and walk up on top of the hill and look down, all of a sudden those cars start moving very slowly. And you can see a break in the traffic, and that allows you to run down from the hill and cross that highway. Now, that was an analogy with a gentleman I worked with at a bank with years ago that told me that, an older gentleman, which I still hold true to this day. But that's a great analogy to take into consideration when you're looking at short-term trading and how dangerous it can be. So now, short-term trading is effective, providing you have a bigger-term picture. Now, when we look at the dollar index, the dollar based around the non-farm payroll has had a very strong week last week based around the hopes that the Fed is going to start ending tapering, But I don't think that is going to lead to raising rates anytime soon. And I don't think the situation with the U.S. dollar to any extent has really changed to any real larger degree since, believe it or not, the inception of the euro. Now, when I look at this going back into the monthly time frame, so if I go back out a considerable distance, we can see we have a trend line coming in here on the dollar index, which basically is about 84.71. Now, more importantly, we have a series of moving averages that I've put in here for this week's webinar to guide us now. Again, a lot of people will say that moving averages are a lagging indicator. Based around a crossover, that can be argued. But if a moving average is sitting still and it's moving with the market and it's being used as a pivot point, then it's not lagging, it's leading, because it tells us where a critical level is. Now, what we can assess from here is that the market crossed over this white line, which is the 100-day EMA. It did that back in 2002. Now I'm going to bring this up here so everybody can see it. You can see that December 31st, November the 30th, 2002, is essentially when it crossed the 100-day EMA. Now, you can use a 200. I know people like 50-day EMA. They like a 200-day EMA. I've worked with a lot of people that love 75-day EMA, 125-day EMA. For the purpose of this webinar, we're going to use the 100 because I think it's valid. And when we look at this, we can see that it crossed this area back in again, essentially this November, the end of November of 2012. We've had multiple retracements higher, but we've never had, again, since 2002, a sustained break of this level. Now, we've gone months at a time, but ultimately, much like what it's doing right now, it's broken lower. That's the bottom line here, guys. So when we look at the primary trend on the US dollar index, I think we would all agree that the primary trend is down from a longer term perspective. Now, what we have to do now is deal with the day-to-day trading and how it affects the other currency pairs. Now, again, when we look at this, we can put our other indicators in here. You can see that I've got the RSI for today's webinar. I've added a third level to this, the 50 level. I talked about this in the previous webinar, that the 50 level is very important. Your average traders, they use the RSI solely for overbought and oversold. And I'm certainly not going to suggest that that doesn't work. I'm saying that's like using a stochastic, a MACD, for overbought and oversold when there's actually a momentum play there that's completely ignored. And in most cases, the overbought and oversold signal is not necessarily wrong. It's maybe ahead of the market a bit, and the market just ignores it and keeps going. So when we look at this, we can see from this that the stochastic is going lower. The stochastic for this webinar, I have it set to an 833. That helps speed it up a little bit, get some of the lag out of the stochastic. I like it, but I'm never going to trade solely based on one indicator. That will never, ever happen. Okay, so when we look at this, we can assess that the RSI is moving in one direction and the stochastic is moving in another. And it's right on this very important 40 line. The two key levels for a momentum trade is 40 and 60. 50 is the difference between bullish and bearish. So we can assess here in the D1 time frame that we're a little bit overbought in the stochastic, but the RSI is saying we're going higher. We have a clean break of the 50 and the 60 line, and that's led to a fairly significant move. And we broke the trend line. This looks like a clear-cut bullish case. Now, in actual fact, it probably isn't. And we're going to come to the next stage where we look at monthly and seasonal patterns. What you can see here is I have a straight line drawn right down the screen. There is 12 months going back to November 16th, 2012, where we currently are now, which is November the 12th. So we're moving into that week of the 16th. I also have another white line drawn straight across the screen. Now, what I can tell you is that over the last 3, 4, 5 years, that regardless of your Elliott waves, your Fibonacci, your trading like a bank, trading on institutional flows, all of these different things that suggest that we should be trading a certain way, and all of our indicators, our MACD, our stochastic, our moving average crossovers often are trumped on the 16th of the month by what can only be a massive institutional order. There isn't a bunch of them. It usually appears to be just one or two, and it starts between essentially the 12th to the 17th. Something goes on in there. So the dollar tends to rally, and then it takes a massive hit. Now, this line, you can see that we are exactly where we were last year, almost to the day on the dollar index at 81.46, and we're already failing at this level. Now, I'm not saying that the dollar will absolutely move lower. I'm saying that what appears to be such an easy trade of buying US dollars probably isn't. Now, you can see here that I have the 12 lines drawn here, 3 of which are yellow. When that cycle, the dollar did not sell off on the 16th on that particular day, but the other 9 times it did. So basically, if we're buying US dollars in the latter part of this month, there's a 75% chance that it's going to go the other way. And this is based on multiple years of analysis of looking at this. And this is something that I discuss with my own clients on a regular basis, that around that type of month, around the 16th, 18th of the month, and even starting around the 12th, 13th, 14th, we have to be very, very cautious about buying dollars. So we can assess so far in the webinar here today that on the monthly time frame, the dollar is in a massive downtrend, and it has been in that downtrend since 2002. We can assess that we have a monthly cycle here where 75% of the time the dollar sells off around the 16th of the month. Does that have something to do with a Fibonacci level, with an Elliott wave, with pick your indicator? In my opinion, it has nothing to do with any of these indicators. It has to do with governments settling their trade balance. They have to, if the U.S. buys a bunch of goods from the Europeans want their trade balance settled monthly in euros, not in dollars. There's a conversion there. That's why we see repetitive patterns in the Forex market. And that's why it's one of my favorite markets to trade, for that very reason, that it's repetitive, guys. You cannot argue that on this point right here, and I'm going to bring this up so everybody can see it, on this point right here, we are exactly where we were 1 year ago to the number. And that's what the average trader misses. Excuse me. Now, this is not that you're not trading like a bank. If you're trading like a bank, you would see this. Well, that's just not true, because an interesting article here just on FX Street just I think it was only a week ago, where they talked about how the fact that Barclays ordered 3 other traders to stand down when they work for the bank. So suggesting that if you trade like a bank, that's how you'll make money. That's not actually, I don't think that that's actually true. I think it can be, but I think that you want to have your own style of trading, and you want to look at seasonal patterns and monthly patterns and put them all together, and then look for repetitive patterns. And that is what will help you avoid getting caught in a bull trap and getting caught in a bear trap. So when we look at this, it's very important that we take notice of this. Now, that's not to say that the dollar couldn't blow through this, but then we have to worry about, is it a false break? So in this particular case, we go back to our initial chart. We look at our trend line resistance, and we can see that it's broken on both sides. This is a very mixed trade. But up here, this trend line here has been in place since it originally formed in July of 2010, and it was confirmed in March of 2013. So you have a new trend line formed. You have the 100-day down here, and then you have a broken trend line at 81.73. Lo and behold, exactly where we are right now. So we may enjoy a little bit more buying of US dollars, but after that, guys, towards the end of the month, we want to be very, very cautious and watch this critical level of the 81.40 level that I've discussed here in this week's video. It's very, when you break it down like this again, it's very difficult to argue these cycles. And these cycles are based on nothing more than looking for a point where the dollar peaks or close to where it peaks and then sells off. So what will that do to your currency pairs? That will send Euro US lower. That will send US Swiss franc higher. That will likely send Great Britain US lower. US CAD can go either way. Aussie US, New Zealand US are not in the dollar index. So that's not really, they kind of tend to go on their own way because they're carry trades, but essentially the main currency pairs, we can do that assessment. So keeping that in mind, we're coming into now, again, multiple time, always thinking of going into the multiple time frames. When we look at Euro US, what is going on with this pair? When we look at this, we actually have a break of the trend line on the monthly time frame. The monthly time frame is absolutely lagging, and if you're going to trade this, you need very wide stops. There is no question about it. but it does help give you a feel for the overall general market bias. And right now, it's still technically, while we're above 131.56, we can layer in our levels 132.43. It still has a bit of a bullish tone to it. When we come back into our weekly time frame here, we can see on our weekly time frame that we've broken this trend line down, but we still have support here, 132.24, and more importantly, 133.43, 133.43, excuse me, where the euro bounced today. Now you can see this yellow line. I've put an additional moving average in there to put a buffer between the trend line, the 100-day EMA, the 25-day EMA, or a 20-day EMA. Even if you want to use a 10 or a 15, that's your call. Just put something between it. If you're using I've seen 200-day, 50-day, 25-day. I've seen it layered in that way. But the main thing is layer it in. So from here, on the weekly time frame, it's pointing lower, but we still are above that key level between 132.24 and again, this level right here of 133.54. As we come into our daily time frame, we start to see that we broke a lot of key levels, but in this clump here of congested area, we have 133.98, which is the 100-day EMA, but we broke in the trend line support. So when we broke through this trend line, you can see that the RSI, we have an 8 RSI, we've got three levels here, a 60, a 50, and a 40. When we broke the 50, it continued to accelerate down. And this is on the daily time frame. And again, even the daily time frame can be somewhat lagging, okay? But the fact of the matter is, on the bigger scale of things, with slightly wider stops, lowering your position size, you can catch a really big move here, guys. You really can. So we know where the target line, that bottom trend line support here was 134.60. We lost that area, and it started to accelerate down. Now, with a proper trend line, I've also talked about this in the previous two webinars, how to identify supply and demand. Supply and demand, for a demand line, we will have two candles to the left, two candles to the right. That will create a demand line. That means that basically when the price approaches this area, stalls, the candles start rising, there's demand for this currency and price rises. Now, the same thing in reverse, when a supply line, when supply is filled, price goes down. Up here, you can see we've hit the high point. The two candles to the left are lower. The two candles to the right are lower. We've hit supply. Supply is filled. Price goes down. As it accelerates down, this is a massive move. Now, this is on a daily candle. So people will say, well, you know, the market, moving averages, this, that, lags, all these different things. And again, you have 1, 2, 3, 4 candles where the market basically just plummeted lower. If you entered in any one of those 4 candles, you're making money, guys. And it had nothing to do with trading like a bank or Fibonacci or Elliott waves or any other thing other than, in this particular case, price action, right? So we have a price action. We have a bearish. We can also apply candle technology to this. A pin bar candle, where basically you have an inverted candle where the bottom of the wick is smaller than the top, and instead of a long needle going up like this one, it becomes what's known as a bearish pin bar. So you have a number of different warning signs that this is moving lower. Now, as we start coming into our week-to-week trading, and I'm spending more time on Euro-US because I know it's so very popular. So people want to know, what's going on with Euro-US. When we look at this in the H4 time frame, again, we can identify our supply and demand. Our demand is met right here at 133.17. We have a long wick down. That's actually a bullish pin bar. So there's the fat part of the wick is at the end of the wick, and we have a long wick that comes down from this, and then two candles to the left, two candles to the right are higher, and then price proceeds to move higher. So on a day-to-day basis, in most cases, the H4 time frame, there will be far less trend line breaks in the H4 time frame than any other time frame, in my respectful opinion, based around this type of trend line. Now, again, when we look at our indicators, when we break above the 50 line, you can see that our 3 and our 6 day, which are our blue and our white line, is a 3 and a 6 day cross. When they start to cross, again, it starts to move higher. Now, again, we see all these things, and again, I think somebody's having a problem with a voice connection there. If you want to send a message to the host will get to assist you with that. Now, when we look at this again, we've broken this trend line right here, but again, we have layered moving averages in, and with these layered moving averages in, we can assess that we are still in a downtrend here. Okay, we have to be very cautious about buying, but again, if we look at the dollar index, we look at all these different things, it's still, the euro is still, it's still technically bullish. It really is. When we look at the state of the U.S. now, with the ECB cutting rates, that is a fundamental that's probably going to keep the upside limited. So that kind of stabilizes things, and it allows us to look at how to play this. Now, as we come down for short-term trading, so we've looked at longer-term, medium-term, now we want to look at shorter-term trading. The shorter-term trading on the 1 hour time frame, we see a clear bullish signal here. When we have our lower support levels that we've identified in the longer time frame, in the weekly and the monthly, still technically bullish. Now we come into the hourly. So our way to trade this is as that dollar index, because we've looked at the dollar index and we know Euro US, the correlation basically 100%. From here, we can make the assessment that we want to think about going long. If the dollar index is moving lower, Euro US is moving higher, US Swiss franc is moving lower, bottom line. So in this particular setup on the H1 time frame, you can see we've got our demand line here. Our RSI is coming back up out of oversold territory and accelerating higher. But does this mean that we want to stay in this long? So if you're a short-term strategy would be to look at this, take your 20, 30, or 40 pips and get out of this trade, because the primary trend on the daily is saying that we still have some more downside. So a lot of times what you can do is remember the key thing I'm going to say here, statistically. And people say Forex is the Wild West and this and that. That's just not true. Currencies move 1% of their value per day. That is a statistical fact. Stocks move 10% of their value per day. Forex is not more volatile. When you leverage your account, it becomes more volatile because the P&L goes crazy on a massively leveraged position. So if you're not leveraging your position and you understand that most currencies only move 1% of their value per day, then that brings things into perspective here. So you can go 1-to-1 leverage, 1-to-2, maybe even 2-to-1 if you're feeling confident, but keep your stops tight. So in this particular case, once this demand line forms, we know that we don't want our stop. For example, say we're entering here right around 133.90. And we have our trend line down here at 133.50. And I will often see people, what I often see is people putting a 20 pip stop on there, and that's it. But they're not taking into consideration that there could be a demand line below that, and they're inadvertently stopped out. And they've got this super high leverage trade, 10, 15, 20-to-1. That's insane. It's very unlikely that you're going to be profitable from that perspective. And if you keep in mind with what I'm saying, 1% per day, then you should be fine. Now, with shorter term trading, in my respectful opinion, that is the 1 hour. And I would be very cautious going below here. I do not trade the 1 minute, the 5 minute. I do not look at those time frames. I think that there's too much noise down there. So from the 1 hour up to the daily, that is where you are more than likely going to be profitable. When you go into these lower time frames, you're going to have a lot of problems and just constantly chasing the market, getting stopped out, wild price swings, but things smooth out in these higher time frames. Now, again, looking at the Great Britain, going into the same formation of Great Britain, US, when we go out to our weekly time frame or our monthly time frame, we can assess that this is bullish. We've broken our trend line, but how are we going to trade this? We have a massive resistance area at 164.03. There is no guarantee that this is going to continue to move higher from this level. If we can break this, and this one is of great interest to me and to my clients, is that we broke the 100-day back in August of 2008. We've had multiple retracements to that level, but we have not been able to clear it. So for now, this is bearish. So when we look at it going all the way up to the monthly time frame and then coming back into our weekly time frame, we can see another sell happen here at 162.51. So the question is, how do we want to trade this one coming into this week? Well, on the daily, we can see we've got a trend line forming right here, and we failed at that level. So clearly, shorts are still on the table. So we need to pick our areas, but we have to watch out here. In the D1 time frame, we have 157.96. So how we would play this coming week is likely sell it down to this level and then get ready to turn around and go long based around what I said with the dollar index and what happens to it in the month of November, what happens to the dollar index around the 15th, 16th, 17th of the month. It sells off. That's going to put indirect pressure on the Great Britain U.S., upward pressure. Now, what is another factor when we're talking about key cross pairs and how to use them for market direction, focusing on these two particular pairs? In this particular segment, I'm going to bring in another tool that I use, which is the Vantage Point software. From here, I can split the screen, and what a lot of people don't realize is that Great Britain, the UK's biggest trading partner currently, is not the US. It's Berlin. So when we look at it from that perspective, there is going to be a lot more currency transactions, institutional transactions happening between the UK, right, and the UK and Berlin. So that translates into euro and the British pound. So when we look at this, in every single instance, when this has happened, in every single instance, then when there's a spike on euro Great Britain, the immediate spike happens in the British pound. The British pound loses its strength. The British pound is trying to rally up, right? And then it fails. Now, this is an inverse correlation to the British pound US dollar. As of late, in the years past, if euro US went up, Great Britain US went up. It was just a simple no-brainer. That's not what's happening these days, guys. What's happening these days is euro US and Great Britain US have been going in two different directions at times. And the smart trader that's looking at the intermarket analysis and focusing on what's happening over on euro Great Britain and using that as a trigger on how to trade the other two pairs, euro US and Great Britain US, that's the one that's making money. So we can see here that as euro Great Britain sold off down here, right, that immediately led to a buy right here on Great Britain US, which is fantastic. So even though the dollar may have been theoretically, technically strong, Great Britain US moved up anyway. The influence in that particular case was not the US dollar. There was more influence coming from the euro Great Britain cross pair. So when we're looking at key cross pairs and how they influence other currency pairs, this is one of the biggest ones that I can see right now, and ones that I use with my own guys, my own direct clients, when I'm advising them that they want to go long Great Britain US, they want to go short euro US. We look at the US dollar index first to get a gauge of the euro. Then we come over and look at euro Great Britain to see what the primary direction of it is. So if the primary direction is down on euro Great Britain, then I'm going to look at potential. If I'm going to go long on one of the two pairs between euro and US, I'm going to lean towards Great Britain US because the pressure on euro Great Britain is to the downside, which indirectly supports the long on Great Britain US. Great Britain US. Now that does sound a little tricky, I'm sure, but once you get the feel for it, it's actually fairly easy. Now, when we're looking at this right now on the daily time frame with Great Britain US, you can see that it hasn't actually even broken the trend line. If we look at Great Britain US and the pressure that the downward pressure that euro Great Britain has been under, you can see there was a massive trend line break on euro US. So there is a lot of, again, a lot of validity to what I'm saying here if we're focusing on that. So I know that if euro Great Britain is crashing and I'm going to go short either euro US or Great Britain US, then I'm going to focus on that short trade. I'm going to lean towards the euro US. That's how that's going to play out. So hopefully that gives a good idea of how to combine, using intermarket analysis, using a number of different indicators, combining these indicators And this is what really will help you get a good feel for the market in the longer term, combining intermarket analysis and a number of other different tools. Now, with U.S. Swiss franc is, I won't spend a lot of time on that because I'll make sure I touch on most of the major pairs. When we start on the daily time frame with U.S. Swiss franc, and again, what I've said, remember, is that this one is basically about a 98% correlation to the U.S. dollar index. So if you're going to trade U.S. Swiss franc, yes, you should be looking at Euro U.S., but more importantly, guys, you should be looking at the U.S. dollar index. We know that we have a critical level on the dollar index at 81.46. This translate, you can see the same critical level at 91.96 as U.S. Swiss franc tries to break through this 100-day EMA. And it's just simply unable to do it. Now, we have an upward price projection target of 94.18. I think it is a good shot of breaking through there. But again, with a 1% move per day, that's not going to happen overnight. This could take 3, 4, 5 days before this happens. But if we count on 3 or 4 or 5 days, moving towards the latter part of the week, it becomes less and less likely that that's going to happen. And that's where we have to gauge this. Right now, we can see in our stochastic, we have an overbought condition here, right? We have an overbought condition on the D1. We look at the RSI starting to turn down. So in this particular case, when we go out to our monthly time frame, all the way up to the monthly time frame, we have layered areas of resistance here. The 25-day EMA, 93.33, the upper trend line, right? We have the upper trend line at 97.42, the 100-day EMA, 106.22. When we come down to the weekly, we have a very similar picture. And this is what I'm talking about, layering some of these levels in as pivot areas. We are unable to clear 92.23, which is the 25-day EMA. On the weekly time frame, we have our 100-day sitting up here at 93.35. Again, the primary trend on this pair is very, very clearly down. So we're looking for opportunity coming into the H4 time frame. When we look at the H4 time frame, we can see we have a supply line formed in. H4 is a fantastic time frame to trade on a day-to-day basis because remember, there's going to be far less trend line breaks, right? So we've assessed that we're under the 100-day EMA here, guys. We're under the 200-day EMA. We're even under the 50-day EMA on the daily, the weekly, the monthly. So the primary trend based around what's supposed to be a lagging indicator is giving us a very clear direction in which way we should be trading this. We can trade counter trend longs based around the D1 time frame, and we want to exit these trades up around this level. And think about getting back in long if we can get a sustained break of 91.96. That's what we're looking for. Okay. So right now we're certainly trying. We've had 4 days where it's hugging this white line right around this area on the D1 time frame, but we're losing our momentum on E4. That doesn't mean we're done. We're still above the 100-day EMA at the 9100 level. So I suspect we'll come somewhere between 9100 and 9115, maybe at the 9130 area, and then we can think about turning around and getting long again. But again, we have to watch that dollar index very, very closely. If the dollar index, and I'm going to come back to that for a minute so everybody can see this, if the dollar index can take out this key level, this white line here at 81.46, then we can go ahead and buy at will on U.S. Swiss franc. But right now, we have on the daily time frame over here, we have 1, 2, 3, 4 failures at this level. So now it's still holding firm at 81.21. This has got a good shot of breaking, but it needs to get going. So if we start to have a deeper pullback from this 81.46 area, we've got a problem. So very important that we're looking at the multiple time frames and understanding this. Now, as we come into our dollar yen trade and how we're going to trade this week, is that the dollar yen is a very, very funny pair. We're going to come right out to the monthly so we can assess what's going on here. We are above the 100. We're above the 25. Things look good. Our 3 and our 6 is still holding across, but we've got some pretty stiff resistance at 102.94. If we come into the weekly time frame, we've got a trend line break and a price target of 101. So buying on dips is the favorite strategy for this week. But where do we put our stop? This is the key thing, specific areas to ensure that you're not taken out of this trade. So if we're going to trade this, we're going to come into the H4 time frame and we're going to look at the key levels. Right now, we've broken that trend line. This other trend line is forming 99.25, but this area right here, if you're trading this long today, make sure your stops are below 99.03. For the week, where do we want our stops for the week? If we're counting on a bigger break, we technically want our stops under the very minimum of 90.39. So we would have a slightly smaller position size and a bigger price target. So again, money management is key here. If we can pass through this, then we have a good shot of this thing getting back over 100. 100 is going to be a psychological level for barrier options, exotic options. There's probably options tagged all over the place up there. So they're going to try and push it through that 100 mark to take out those options. That's what they're going to try and do. So we have to be careful of a false break around the 100 level. But again, right now, it still points towards a bigger move to the upside. In the hourly time frame, 99.47 to 9900. So even your short-term traders on the 1 hour time frame, you want to keep your stops under the 99 level, and buying down here into that level is a decent play. Now, we're going to keep moving a little quicker here so we can get through all of our currency pairs, and I can still take some questions at the end. Aussie US. Now, the first thing I want to do is come way out here to the monthly, just so I can show everybody what's happened down here around this level. Now, that's around the 90.27 level. It appears that we are going to start moving towards this level. You can see that this was a massive level. When we broke above this level, it was April of 2009. We have never been back below this level. We tried to get below this level, and we had a 600, I think almost a 700 pip bounce off of this level. So right now, we are trapped here between the 25-day EMA and the 100-day EMA, but we know how to play this. Right now, you can see that the RSI is giving a completely different signal than what the stochastic is. The stochastic is saying, go ahead and buy. The RSI tagged it. You're still below the 50 line, and it is pointing down. Not surprisingly, it has moved lower. When we come into the weekly time frame, we have a trend line break. That trend line is broken, and it's still moving lower. In this particular case, the stochastic and the RSI agree with each other. That is the kind of signal we're looking for. We are below the 100-day EMA. We are below the 25-day EMA. The 3 and the 6 have crossed down. All of these indicators are in agreement. And as you can see on the weekly time frame, the last 4 weeks, the primary move has been to the downside. When we come into our daily time frame, how to play this. Again, this is a critical time frame. We have lost that. So for the last, we peaked up this trend line right here. The very next candle that opens, you short it. Supply is filled. If supply is filled, price drops. That's it. And you can see, once again, any day that you got into a short trade on this, it was a profitable trade, guys. Bottom line. The RSI tagged the 50, kissed the 50, and then completely rejected it, then broke the 40. Price action accelerated. So knowing where to put our stops here, pretty easy. We put it above our trend line support at 94.98, and we ride this thing down until we see a potential turning point. Now, when we come into our H4 time frame on this, the trend line's broken there too. The RSI is getting into no man's land. We're at 9.7 on the RSI. When we're looking at the H4 time frame, we are going to look for a new demand line to form, and then think about going into counter trend longs. But we have to see how the dollar index plays out. Very important. But again, there's a play here. We look at it in the hourly. We can see that again, we come into the same formation here, the RSI, stochastic. We have the 3-6 cross to the downside. We have a trend line resistance coming in. The 25, it's under the 25. It's under the 100. So you want to play. I hate to use the word trend. I'm not a trend trader by any stretch of the imagination. I follow price action. That's what I do. I am not that concerned with Elliott waves or Fibonacci or trading like a bank. Some of these ideas are ideas, but the fact of the matter is, when a big order comes in from a government or a bank, usually the market is going in the opposite direction, and then they slam it the other way. And that's where we have to be careful. And that's where I spend an excessive amount of time talking about what happens around the 16th of the month. And again, it's very important that we respect that 75% of the time, that's what happens. So if it happens this time, the Aussie could be getting ready for a bounce. So that's something we want to be very careful of. And again, the New Zealand is an interesting one. The New Zealand, we can see when we come all the way out to the monthly, we look at our longer time frames first, massive support sitting down here at 77.51. This has been in place since April 2012, December 2000. Resistance has been in place since about December, approximately 2010. That was confirmed up here in December 2012. So that points towards New Zealand has a rough time in the month of December. I think we would all agree on that. So we are leading towards the month of December. So, but we're trapped right in the middle of the range. This is probably the toughest area to trade this when it's right in the smack dead in the middle of the range like this. So this is the benefit of coming down to the lower time frames for our entry in our direction of trade. Now this week with my own direct clients, I've only suggested shorts on New Zealand US because of what we're seeing here. We have the weekly time frame. We've got a trend line resistance coming in. That's probably going to switch out actually to about 85.70, but for right now, 83.75. You can see we have that one push up above. And there's that critical candle that I talked about. And I put a little happy face on there so everybody can see it. That is a bearish pin bar on a weekly time frame. And usually they're not that often are they wrong. They are wrong, but they're usually when they're like, again, any one indicator combined with another indicator, that's a winning combination, guys. One indicator hanging your hat on one indicator and saying, this is the one that's going to make or break me. It's probably going to break it. It's not likely to make it. Okay. So when we combine multiple ones together, that's what we're looking to do. When we come down to New Zealand into the daily time frame, the picture becomes a little more clear. And there again is that elusive pin bar candle, bearish pin bar that we don't see that often, but when combined with a trend line, you can see the outcome. Now, on the daily time frame, this is a concern. 81.84 is the 100-day EMA. This has been providing support. If we can break this, I have a price projection target of 78.48, but we have to make a clean break of that 100-day EMA. Looking at what's been going on with New Zealand in the month of December, that's very likely that it could happen. So when we look at the RSI in the daily time frame, we're sitting at 35, below 40. Looks good. Stochastic is still surprisingly in agreement. But with the stochastic, what I want to talk about too here is that when we look at it, it's oftentimes the stochastic will go into overbought or oversold very quickly, often too quickly. And then what we do is we change it out to the standard stochastic of 14, and then it lags too badly, and it misses the signal that way. So it is effective, the stochastic. I find it the most effective, in my respectful opinion only. You're free to use whichever one you want. It works the best on an 833 in combination with another indicator when it breaks through the 80 or it breaks through the 20, right? So when we look at this particular situation right here, you can see that the stochastic is in oversold territory, but on the daily time frame, the market continued to move lower for 4 more days. When the stochastic broke above the 20 and the RSI started to break above the 50, we got a nice signal. The same thing on the downside. If we're playing in between this 80 and 20, that's when I find the stochastic the most effective. When it pushes under 20 and it pushes over 80, be very, very cautious with that type of signal. Case in point, right here. The stochastic actually went into overbought territory at basically within the beginning of a much, much broader move. And that's and it stayed in overbought territory. Then it came down, gave a signal here, which was also could be considered to be somewhat of a false indicator, and it broke higher. But you'll notice that the RSI never broke below that 50. It kissed the 50 right here, went right back here. But even during this period of consolidation, when the market was moving sideways, it still said to stay long. The RSI said to stay long. Bottom line, and that's what you're looking for. But again, I don't want to mislead anybody by saying that stochastic is not a great indicator. It is, but not by itself. Not ever by itself. So we're going to go into our final pair here for our outlook for the week. And I think it's a real good one to look at because I think there's some opportunity on this one. The US CAD. Now, this one is frustrated the best of the best, including yours truly. So right now, we have a couple of key levels. For a complete and utter trend reversal, we have to break through 105.93. That is the upper trend line. We then have to take out 108.82. This is a tall order here, guys. This is a very, very tall order. So, but this is the monthly time frame. Okay. So when we look at it from that perspective, we are still within the range of 105.93 and the current bottom at 102.90. When we look at the weekly, we are banging against the door, trying to break through this for 3 weeks. Okay. This is indisputable analysis. When we look at this, we know exactly what's been going on. In this particular case, this is a fantastic way to trade this, is with a simple straddle, guys. And unless you're in the U.S., I know the U.S. are not allowed to go long and short, but in this particular case, you are. So if we're selling this into this 105, 104.90 area, we have our stop at about 105.20, and then we have a buy limit order at 105.30. And that's a great way to play it. And that, because that, for the last 3 weeks here, guys, that's the only game in town. You can buy it on the way up, and I don't dispute that's a good trade, but you have to be aware of the dangers of what lie up here, and it is very dangerous. On the weekly time frame, we are starting to get a little bullish here. We're trying to break through this level, but even this, you can see the resistance is layered through the different time frames. The RSI is pushing higher. But again, we're starting to, it's a very difficult call on this one. So with this particular trade, that's how I recommend it, is that we sell it near the top of these trend lines, and we keep not only a stop, but a buy limit in place. And that type of a straddle, either way, guys, you're likely to make money. That's the way you want to look at it, because if it holds, we make money. If it breaks through, we get stopped out on our short trade, and we immediately enter into a long trade. And if it breaks through this weekly trend line, it's probably got a free run right up to at least the 106 area. So again, we got maybe a 20 or 30 pip stop, right? 20, 30 pip stop, and we got at least 80, 90, 100, maybe even 200 pips on the upside. But hey, the downside's wide open too. So if that short trade holds and our stop is not triggered and that long, that buy limit is not hit, then we've got a fantastic short opportunity down to the bottom of that trend line, back down towards the 102, 103. And if we look at it on the daily time frame, the lower trend line, the 100-day EMA is way, way down on the 103 level. So potentially for a 20, 30, 40 pip stop loss, you've got the possibility of picking up 200, 300, 400 pips. And as you can tell, I've already done this trade a few times over the last several months. So again, we've looked at a lot of stuff. We've looked at multiple time frames. We've looked at short, medium, and long-term setups with US CAD. US CAD, you can see again, when we take that same methodology from the longer time frames and then apply it to the hourly, we assess that we have even on the hourly, we have a supply build at 105.06. When supply fills, we enter the next trade and we go short and we keep the stops tight. We have the buy limit in place, no harm, no foul. That's the way you want to look at it. Very, 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 very effective way of playing this until it makes its decision. There's going to be a big, violent move on US CAD, guys. I guarantee you that, and it's coming. And it's going to be probably this week or next. So until that happens, we can continue to make money off this, bearing in mind that the currencies on average, 90% of the time, they only move 1% of their value per day. That's it. So we've looked at key levels where to put these stops. We've looked at the seasonal patterns with the dollar index. We've looked at a major review of the U.S. dollar index. We've identified the primary trends, what the primary trend is, what it's doing right now. So right now, what I'm going to do is, because I know we're on a time limit, I'm going to take some questions. If you guys have some questions, I would love to take some of those. Now, somebody has asked me, what is the yellow line from FX Voici, I believe it is. Excuse me if I'm not pronouncing that right. The yellow line here is the 25-day EMA. So when we look at this, I'm going to hold that on here so you guys can see that. I'll bring that up. Sorry, just bear with me here. Let me go on here. So we have right there, you can see the moving average 25. That is an exponential moving average based on the high, low, close 3. And again, this was one type of setup that you can use that will identify critical levels, that will identify areas in which you really want to be aware of. And, as long as the market, key thing with the moving average, and I do hear some people talking, not everybody, but one of the most predominant ways moving averages are used is if the market's above it, it's bullish. If the market's below it, it's bearish. And when it breaks across it or breaks over it, the move will accelerate in that direction. That is, the basis of, I think, how your more senior bank traders and stuff like that will use them. To say that, a lot of people have a very negative outlook on moving averages and say they're lagging, when they use it as a crossover, I've heard many different things. That may be true, but it all depends on what you're using it. Only in my respectful opinion, how you use something and what you combine it with will determine, how something is going to be effective or not effective for you. Now I'm just going to go through here, see if I missed any questions during the presentation. It looks like a few people had problems with logins. Not sure if that was resolved or not. Okay, now what I'm going to do is I'm just going to hold out here to see if anybody has any questions on the presentation. Now, again, I know there's a lot to absorb in a very short period of time. If anybody has any questions about the webinar, you can shoot me an email, and I'd be happy to discuss any of the content of the webinar with you guys for sure. Now, again, I'm just looking to see if we have any questions coming in. Yeah, we're going to have a very choppy week. There's absolutely no question about that. How the week is going to progress is certainly going to be interesting. Now, I think that the dollar will probably hold its gains until the latter part of the week. And, that's when we're going to see, the gains. Now, one of the questions I'm getting is, can you explain fractional disparity I think you're referring to the fraction of a pip that most brokers are offering. I don't even pay attention. If a fraction of a pip is not something that is of any concern to me, I'm not going to allow it to stop me out. Now, again, when you're looking at a lot of the brokers, remember we're on a decentralized exchange in Forex, and every broker is pretty much offering a different spread, a different fraction of a pip, a different this, a different that. So it really does depend on which broker you're trading with and how much a fraction of a pip will actually affect your trade. So now I'm getting another question. What percentages run you on? I'm sorry, you're going to have to repeat that question. I'm not sure what you're making reference to. Maybe if somebody can help me with that. What percentages are you? Oh, fundamentals, and what percentages are you running? Yes, sorry, I got it. Fundamentals and technicals. Fundamentals, myself probably am basically about 80 to probably 80% technical and about 20% fundamental. The fact of the matter is, if we look at the fundamentals, then we know the U.S. is bankrupt. We know that Japan is a mess. And, if we went based on fundamentals, the Japanese yen would be almost bordering on worthless. Same with the U.S. dollar, but they're not. So when we look at certain fundamentals, I think that basically they're truly noise. And the market reacts, then overreacts. Then at the end, by the time the smoke clears, it comes back almost to exactly where it was. Case in point, my theory on the U.S. dollar index and the sell-off towards the end of the month. Regardless of how horrible the dollar did in past years, it still gained strength around the beginning of the month, and it still sold off around the 16th or the 17th, 70 to 80% of the time. Question here, do I trade oil and gold? Absolutely, I do. I do a lot of oil and gold trading by way of futures and, more importantly, CFDs. Now, unfortunately, the Americans are forced to trade futures, but the rest of us here in Canada, Europe, and Australia, everywhere around the world is trading CFDs. Now, the futures contracts are very, very volatile. They are fixed contract sizes that the average trader can't really afford. But CFDs, with many of the brokers that are listed on FX Street, they offer CFD trading in the S&P 500, oil, gold. These are fantastic. And the setup that I've shown you guys here today is 100% applicable to all of those things. The exact same thing, the supply, the demand, the moving average pivot points, the multiple time frames to determine what the primary trend. These are all the things that you want to look at. If it moves, you trade it, from John. Yep, that's pretty much it, John. You're exactly right. If it moves, not only am I trading it, I'm sure my counterpart somewhere across the planet's trading it too, and that's what makes the market, right? Very important that we know that. Now, again, I'm just going to hold out to see if we have any more questions coming in. I really appreciate your question, guys. That's what helps everybody look at the markets and explain things and maybe help improve your own strategies. Now, again, I do work with a lot of people, global people, providing daily trade advice with entry points and everything to in all the major markets, and based around a very common sense approach to things, where I don't want to bury myself in fundamental analysis. I don't want to bury myself in technical analysis. I want to make sure that I have a good feel for the market in multiple time frames. And using intermarket analysis, this is, again, critical on something like, for example, Euro Great Britain. 5 years ago, actually, I even go back further than that with Euro Great Britain. Back 7 or 8 years ago, Euro Great Britain would move, if we're lucky, 25, 28. When I first started my trading career back in 2001, 2002, Euro Great Britain, we didn't even trade it because it only moved, maybe 25, 28 pips a day. Now that thing's screaming 28, 30, 40, 50, 80. I've seen it move over 100 pips in a day. It's a fantastic pair to trade. But from an intermarket perspective, it's fantastic to trade also from the perspective that, it's giving me a guiding light on what to do on Euro US and Great Britain US, and which one in which particular week I should focus my attention on. Now, what we're going to do here is, again, I'm going to hold out for a few more minutes to see if we have any questions coming through. And again, feel free to contact me if anybody has any questions about the webinar, because I know it's certainly a lot to take in for one webinar. So I think I've answered all the questions here for today. I want to thank everybody for attending the webinar. It's great that so many people took the time out of their day to come out and watch the webinar. I really appreciate that. And I want to thank FX Street for hosting the webinar today. Again, a fantastic website and a great deal of informative information. I'm certainly proud to be a contributor here, and I look forward to seeing everybody on the next webinar.